Most women I spoke to had no interest in doing their job illegally. They didn't want to deal with all those complications, both for moral reasons and just the stress of it all. Mm-hmm. So they're paying to reduce all of their risk by working out of an illegal brothel. And I just thought this was sort of cool because when I think of a pimp, normally, a risk market's not functioning well if the person who takes the biggest risk is not getting the biggest reward. And that tends to be true a lot in criminal markets, because you don't have pricing transparency. So you end up like those stories about the low-end drug dealers who bear all the risk and get the smallest payout. Right. Like that's how you know a risk market's not functioning. And generally that's true for sex work too. Pimps push these poor people out onto the streets. They bear all the risk and the pimps keep all the money. So that's a messed up risk distribution. But at the Bunny Ranch, it is actually the house makes its money on removing risk.
That's Allison Schrager, up next on the All Things Risk podcast. Welcome back to the All Things Risk podcast. My name is Ben Catania. I am your host. This is my show, which is all about risk and uncertainty. Because let's face it, we deal with these things no matter what we do, but most especially if we want to do anything significant or extraordinary, we have to embrace uncertainty. I speak to some of the world's most fascinating people and we get into it. So let's get into this episode. And I want to start this off with a few questions. And those are, what can we learn about risk from how services are priced at legal brothels? What does systemic risk have to do with the paparazzi? How are big wave surfers a little bit like actuaries? And what does fraud tell us about how people miscalculate probabilities? I want you to meet Allison Schrager, the author of An Economist Walks Into a Brothel. Allison is an economist, a journalist, co-founder of LifeCycle Finance Partners. She worked academically and professionally on retirement finance. She has worked on some of the most prestigious problems with some of the world's most prestigious financial institutions. And she's written for the likes of The Economist, Bloomberg, Wired, Playboy, and Foreign Affairs. It's this stacking of skills and experience that I think makes her book, An Economist Walks Into a Brothel, so insightful. In the book, Allison looks at the pricing of sex work at the Moonlite Bunny Ranch in Las Vegas, risk calculations of big wave surfers, how poker players stay rational in the midst of high stakes, and a lot more. So many of the risk concepts that she touches on and has studied are highly applicable to contexts outside of finance. And Allison's work exemplifies that. And today she joins us to share her insights in our latest episode. We get into the origin story of her book, brothels, surfers, the paparazzi, as well as a spectacular fraud that went wrong, studying H.R. McMaster and the Gulf War, how a number of financial risk concepts are applicable to wider situations, Allison's 5 rules to risk-taking, the risk-free rate and risk versus reward, knowing that we are all irrational, diversification, hedging, knowing that uncertainty is going to happen whether we like it or not. And she shares a number of colorful stories from her book and how she conducted the research for it. We get into all of that and a lot more. This was a fun and incredibly insightful conversation, so let's get into it. Here is Allison Schrager. Enjoy. Allison, welcome to the All Things Risk podcast. This is going to be fun. I'm really looking forward to this.
Great. Thanks, so am I. I love the idea there's an All Things Risk podcast.
Yeah. Awesome. So before we get into your book, which I loved, by the way, it's just
thank you.
It's awesome. There's so many wonderful things in there. Before we do all of that, for my listeners, could you just give a little bit of a synopsis as to who you are and the types of work that you do and all of that great stuff?
All right. Well, I do a lot of things, but I guess the easiest way to describe myself is I'm an economist who specializes in the economics of retirement, which sounds a lot more narrow than it is. But really because the central question in retirement is a risk problem, right? You have to get, your income that you earn over your lifetime to last your entire lifetime, even when you're not working or have spells of unemployment. I look at it as a lifelong problem. You don't know how long you're going to live, what's going to happen to markets. So it's just one big risk management problem. So I did a PhD in that. And then I spent several years working in finance with some very talented financial economists and have also worked as a journalist on and off this whole time. So I think that's what brought me to writing a book about risk and exploring different storytelling devices we could use to sort of explain risk better.
Yeah, so I'm very curious about the origins of this book, An Economist Walks Into a Brothel. I presume that you didn't start with that, with that in mind, but perhaps through your work, you kind of got there and you had a lot of interesting stories to tell, not just about economists walking into brothels, but big wave surfers and Hollywood movies and things. But I'm very interested in the origin story of that book.
So I said I worked in retirement finance for several years. And the question of my research and my work in industry was always that we've put this huge risk problem on individuals and not giving them any sort of tools or training on how to manage it. Like managing defined benefit plans was very hard. And now we've effectively asked every individual to do that for themselves. So I felt like in my work with financial planners also suggested that people didn't have really good tools to understand risk, but we expected them to. But I know from my work as a journalist what sort of connects with people are stories. So I had this idea at a certain point that I wanted to explore risk topics I felt people really needed to know, like basic risk literacy, but just use that like storytelling devices, like find really interesting risk takers or people that sort of illustrate these concepts in a way people can understand, just so everyone has more tools to understand risk better.
Mm-hmm. Yeah, I think that when we get asked that question, if we're saving into a retirement plan and what's your risk tolerance, and I can't imagine that most people would really be comfortable with that type of language.
I'm not even sure what that means. Mm-hmm. As someone who studied this, my whole career, I'm not even sure like what your risk tolerance means. I mean, first of all, it's so arbitrary. I mean, a lot of evidence are people risk tolerance in one situation is very different in another situation. Even how you might feel about financial losses might vary a lot with how your own personal situation. So I think it's kind of a meaningless concept to begin with. Mm-hmm. I really think when we think about personal finance, we've just got to think about it in terms of income terms and what people are comfortable with and what they can live with. I think that resonates a lot more.
Yeah, I agree. Could we dive into some of this stuff? So I want to talk about, you've divided the book into different chapters and you've got 5 rules, which I really love. I love the idea of these like simple rules. And I want to talk about some of the concepts, and maybe we could bring it out with stories that you illustrate in the book. So maybe we could talk about the risk versus reward side of things, and let's talk about the Moonlite Bunny Ranch and how and pricing of sexual services and what that tells us about risk.
Yeah, so I guess the simple theme of the book is, there's a risk-reward trade-off, and there's just no way you can get around it. In fact, that's always how you know someone's selling you something, is you take more risk, there's the chance for better reward, but there's also more loss. And what financial services does is it puts a price on risk, and that allows you to reduce it by either giving up upside or paying someone to take on your risk. So when I went to the Moonlite Bunny Ranch, initially to do a different story, I was struck by how much they charged. Not only how much do they charge, but then how much of their earnings they had to give back to the brothel. And first of all, they charge about 300% more than sex workers earn in the black market. It's a significant markup, especially when you think it's a lot easier to procure a black market sex worker than it is someone at the Bunny Ranch. We have to go all the way to Nevada and deal with all of their infrastructure. But it's a risk premium on both sides, because you think actually working with a sex worker can be quite risky. There's all these high profile, humiliating things that can happen. If you get arrested, you could lose your family. So I discovered that this 300% markup was actually a risk premium that people pay, because if you go to a legal brothel, it's effectively a risk-free transaction. No one will ever know that you're there. The women are screened for diseases, and that's what people are willing to pay for. But the women also are paying this huge premium to reduce their risk because working in the black market's incredibly risky. Sex workers face very high rates of violence. Most women I spoke to had no interest in doing their job illegally. They didn't want to deal with all those complications, both for moral reasons and just the stress of it all. So they're paying to reduce all of their risk by working out of an illegal brothel. And I just thought this was sort of cool because when I think of a pimp, normally, if a risk market's not functioning well if the person who takes the biggest risk is not getting the biggest reward. And that tends to be true a lot in criminal markets, because you don't have pricing transparency. So you end up like those stories about the low-end drug dealers who bear all the risk and get the smallest payout.
Right.
Like that's how you know a risk market's not functioning. And generally that's true for sex work too. Pimps push these poor people out onto the streets. They bear all the risk and the pimps keep all the money. So that's a messed up risk distribution. But at the Bunny Ranch, it is actually the house makes its money on removing risk. Like they get that spread. The sex worker is paying this huge share of their income, and the customer is paying this huge markup. And that spread is how they earn their money. Effectively, they're providing a risk-free service, and that's how they make their money.
Yeah, that's so fascinating. Have you looked in comparison to other black market activities, like so the drug trade or other illicit activities, how the pricing works?
I have not. I would like to. In the past, I looked a little bit at the dark web, which is just hard to get consistent data on because they keep shutting down the exchanges. But my suspicion is that you would also get a more sensible risk distribution just because you have full pricing transparency, which you normally don't in drug markets. And now we have a great new experiment because we've got legal markets coexisting among illegal markets, just like we do in sex work. Although I said I don't know if really good data has been collected. I was lucky with sex work in that I had access to great data, so it was very easy to measure. I had a relationship with the Bunny Ranch, so they let me come out and take surveys of pricing. And then an economist I'm friendly with had really good data on the illegal market, so I was able to make a clean comparison.
Right, and you said that came about through another story that you were doing.
Yes, on negotiation skills. That's what initially brought me to the problem.
Oh, wow. Okay.
I was spent like almost 2 weeks there studying how they teach people how to negotiate.
Cool. What an interesting assignment. You probably didn't envision yourself doing that when you were in grad school.
No, there were a lot of moments where I was just like, oh my God, if my advisor could see me now. Like I said, like I'm an economist specialized in like retirement, like my whole intellectual community within economics are retirement nerds. That was my advisor. And when I'm just like stepped into the brothel, I mean, there were a lot of moments in the book I felt this. I'm like, oh my God, this is really not what he ever thought his student would end up doing.
Right. But Ken, I think it's so it's such a wonderful book because we do need these insights. And I'd like to talk a bit about this concept of risk-free that you also talk about. What is risk-free? And that's a wonderful lens, I think, through which to make all kinds of big life decisions because it clarifies. So could you talk a little bit about the risk-free rate and what that means? Yeah,
I think it's interesting. When I started the book, I started with the finance, like what financial concepts are so important. And I sort of had this whole outline, and then I took it to Robert Merton, who is one of the creators of Black-Scholes. And just to be like, do you think this is, how you should be thinking about risk, Bob? Do if we're gonna spread the message to the whole population, what should be in here? And he was like, it starts and ends with risk-free. Like risk-free is the sort of what all financial models are built off of. You start with risk-free and you see, is that enough to get my reward? And if it's not, then you have to take risk. And that also, what risk-free gives you also tells you exactly how much risk you need to take. So it's this fundamental building block of all financial relationships. And if you look at any complex financial models, no matter what they are, there's always a risk-free rate in there. Black-Scholes, Sharpe ratios, all this stuff. So, and not only that, if you just think about that's in finance, but if you think about risk-free in everyday decisions, it's actually a very useful concept because it helps you clarify what your goal is. Like no matter what, this is true in either for financial planning or just any daily decision. If you're clear on what you're taking a risk for, you're much more likely to have a successful risk. Like it really is astounding, like all the fancy stuff you can do. But if you just are very clear on what your objectives are, it makes such a big difference. And the handy thing about risk-free is it helps you clarify that.
Right. So this is about, if I was to try to translate some of this for someone who doesn't understand or has never taken a finance course, then you would define what's non-negotiable.
I wouldn't say it's not non-negotiable. It is actually what gets you what you want with no risk.
Okay.
So, for example, if you have $100 and you want to make sure you still have $100 in a month, the risk-free asset would be like a government T-bill. It's a certain rate of return. Nothing's going to happen to it. So that would be the risk-free asset. $100 now will be $100 in 6 months.
Right.
But the tricky thing is about risk-free, and one of the reasons it's so useful is it clarifies your goal. So suppose your goal is $1,000 in 20 years. A T-bill doesn't really offer you that because inflation risk, say, $1,000, you don't know what inflation is going to be over the next 20 years. So you need a different asset. You need like a 10-year or 20-year inflation protected security for that to be risk-free. So depending on your goal, you have a different risk-free asset. And that is also true of just like anything. Like suppose, you're considering what to do for the evening and you could go to a party or you can stay in and watch Netflix. So like, what's your goal? Is your goal to just have a pleasant evening? Well, Netflix is pretty pleasant, probably better than a lot of parties. But is your goal to meet a new person? Like, in which case, Netflix is not your risk-free asset. You're never going to meet anyone staying at home watching TV. You have to go out. So as I said, you can see, what risk-free is for your goal. And of course, even if pleasant evening is your goal, Netflix is the risk-free option, right? You know how that's going to go. But there's also not a lot of upside, right? Like, it's going to be good. But I mean, a night in with Netflix is rarely amazing. So even if your goal is fun, the party has more downside risk, but it also has a lot of upside. And like it could be a really fun party.
Right. So
does that make sense?
Yeah, that makes a lot of sense. So it's about knowing what you want. And therefore, if you have a child and my risk-free is I want my child to go to college or something like that, then you can kind of plan your life around those concepts.
Yeah, well, I guess it's whether, I guess that's also a complicated thing. Is your goal even, you have to narrow it down, financing them to go to college, like so they have enough money, or raising a child who wants to go to college and has the intellectual sort of tools to do that?
Right. Yeah, no, I guess that is pretty complicated. And the college one is really interesting because you have this chapter about, I believe her name's Kat Cole, who actually shunned college because actually what she realized is what she wanted was a certain level of financial security.
Yeah, or she just had an opportunity to reach her goals.
Okay.
Her goal was to be a successful businesswoman, and she realized she didn't know to go to college to do it. Just like, is your goal that your child should go to college, or is your goal that your child is happy and has every opportunity that they can and live up to their potential, whatever that is? College is a very likely way to do that. Probably the most statistically likely way to do that is to raise them with that expectation and be ready to finance it. But it's not necessarily the only way that's going to happen either.
Right. And then therefore you can, as different things happen along the way, you can kind of pivot because you've got your eyes on what it is that you want.
Yeah, as I said, or be clear on what it is you want for your child, whether or not you want a college graduate or a healthy, happy, adjusted person.
Sure. I think for some people, for a lot of people, it's actually knowing what that risk-free reward is sometimes challenging to identify. I don't know if you have any.
Yeah, to be honest, I think it's significantly harder. I mean, you could learn all the math underlying all the models I talk about, and I would think that would be easier than sometimes just really sitting down and thinking to yourself, what am I really looking for?
Particularly, there's so much choice that we have in life, and there's the paradox of choice, throughout, and decision fatigue and all of these things that we get hit with, and that difference between what should we be wanting and doing versus what actually does speak to us.
And we get confused about the goal. Like in the story I told about Kat, she really made her name when she became the president of Cinnabon. And they got so fixated on this idea they needed a lower calorie cinnamon roll. They started producing a really terrible cinnamon roll just because it had lower calories. But she was like, the goal is bigger sales, not a low calorie cinnamon roll. Like, what's the point of making something no one's going to buy? And the same thing is with the college example. Like, I think most people's goal for their children is that they're happy, well-adjusted, and financially secure adults. But college is a way to do that. But is it always the way to do it for every child? Probably not. So, but you can get fixated on the goal. Like, my child must go to college. Anyway, that isn't really your goal. That's just one means to it.
Right. There's so much there that I think people struggle with, but I think some of these concepts really cut through. So that question about what is risk-free for me is a very important one. And the way that you phrase it is, I think it's a great way. I think everyone should go away and identify what the risk-free rewards are.
Yeah, it's a deceptively complicated concept. Like, I think, honestly, even when I talk to people who work in financial services and build complex models every day, even they don't really think about risk-free and its power. I said, even when I was thinking about what the chapters of this book would be, I didn't even at first have a whole chapter on risk-free. Now I have two, because Bob was so adamant that this is the foundation of all financial and risk decisions. Yeah.
Could we change gears, though, a little bit here? And I want to talk about, I want to fast forward to big wave surfing, actually. It's just because I love that chapter. I love the article and the parallels between big wave surfers and actuaries is so unusual, but so obvious when you read the chapter that it blows my mind.
I think it's a lot more exciting for actuaries than surfers. But
yeah, probably. Yeah. I think for a big wave surfer, it's like, you guys are just like actuaries. It'd probably what's an actuary? Or they probably wouldn't think of that as very cool. But
actually, I don't think they mind it as much as you would think. I think partially because no one ever takes them seriously intellectually. Anyway, they are solving these fairly hard risk problems. So I think they also, enjoy the sort of recognition that they're actually much more intellectual than people realize.
Right. Okay. All right. Cool. Could you describe the problem and the techniques that big wave surfers use to tackle big waves, and then how that creates other problems?
Yeah. So, their objective is clearly, surfing a big wave. For a variety of reasons. It might be just a personal satisfaction. It might be getting famous in your community, just whatever spiritual quest you're on. There's a lot of reasons. But the thing is that's interesting about it is, like a lot of things in life, in the beginning, when people started surfing big waves in the 50s, it was just like maybe 5 guys who all had these just amazing swimming powers. And they'd surf off the North Shore of Hawaii. And if they wiped out, they didn't even have what they call a leash, which is like something that tethers you to your board. You would just be trapped in this sort of really rough surf, and you'd have to swim maybe 5 miles in really rough surf to where you could go ashore. So the only guys out there really knew what they were doing. And a lot of people still died. So over the years, they developed all this technology, which is really very similar to what we do in finance. So in finance, you take a risk and then you manage it, which is, effectively you're cutting down downside risk. So risk is everything that could happen, good and bad. You want to, in finance, maximize the good and reduce the risk of the bad. And you can do that 2 different ways. We have all these financial tools that have been invented to do that. There's something called hedging, which is giving up upside in exchange for reducing downside risk. So it would be like diversifying your portfolio from stocks into something with lower risk, like bonds or risk-free asset, however you find it. So in surfing, they kind of do that too. So they do hedging by, waves travel in sets, right? So you have 5 big waves, one after another. And that first wave in a set might be that ultimate big wave that surfers talk about. But they would never surf that, because if you wipe out, you got 4 waves that are going to be crashing on you and you could drown. So they'll wait to the 4th or 5th wave. Anyway, it might not be as good a wave just because it's safer. So that's like a hedge. And that's, I guess, a low-tech innovation. But the more high-tech innovations are what has made it controversial. So it first started with the leash, which meant that if you wiped out, you were still trapped, you're still on your board and you could just paddle to shore, so you didn't have to swim 5 miles. So that immediately introduced weaker swimmers to the sport. And then the big innovation, and the guy I met in Hawaii who came up with this is named Brian Keolana, who comes from a long dynasty of surfers, is jet skis. So jet skis are effectively insurance. So that's the other risk management technique is, you don't have to give up your upside, but you pay someone money and they take away your downside risk. So that's insurance. It's like if your house burns down, you get something. So jet skis are insurance, and that if you wipe out, something's sitting in the water to rescue you. Now, both hedging and insurance in finance always are interesting because you can always flip them around. They can either reduce your risk, or you can use them kind of backwards and lever up, say, and take on even more risk. So that is also true of jet skis, in that they can be used as insurance in case you drown, or they can be used to push you on a bigger wave. Like, so now this is called toe-in surfing. So big waves move fast. So the human body can maybe only paddle onto a 40-foot wave. But if you have a jet ski pushing you onto a bigger wave, you can maybe surf an 80-foot wave. That's obviously a lot more dangerous too.
Right.
So it's very similar, I guess, to financial derivatives, which are in theory insurance against stock prices falling or any asset price falling. But they could also be used to lever up, which happens a lot in finance, so you take on bigger risks. So when I went to the Big Wave Surfer annual risk conference, most of what we spent a lot of time talking about risk techniques, but we also spent a fair amount of time debating, what having these tools means for the community. It really, and if you go to sort of a financial economics conference or a pension risk conference, it's really the same debate, which is where does responsibility lie when you use technology to lever up and take more risks? There's obviously a lot more upside. You can, save less and get a higher return. But particularly in financial services, what if you're taking these business risks and they start posing risks to others? What if there's negative externalities? And that's true for surfing. If you are surfing a wave you shouldn't be surfing, so you don't have the skills, now all of a sudden you have to be rescued, you're really posing harm to other people because you're diverting resources. So the question is what's the right role for personal responsibility? What's the right role for education? And what's the right role for regulation? And I don't think anyone really has great answers for this. But this is, I don't know if the surfers have come up with a better answer, but it does definitely what gets debated at any risk conference I've been to, including the Big Wave Surf Risk Conference.
So you get, for instance, surfers who aren't that strong a swimmer going out and attempting to surf a 50-foot wave.
Exactly. Like you and I don't know about you, but I certainly have no business doing this.
No, neither do I.
But with a jet ski, I could now conceivably surf a large wave. Anyway, I really don't know how to surf at all. But if I were to do that, I would actually be posing harm to others. So, the question is, where does responsibility lie? And, the question I kept asking them, because this is, it was amazing how they're having these debates, and I'm just using the debates we are having in financial services now and just applying them to surfing, and the questions work perfectly, and they were all really impressed that I was so insightful. But really, it's just they don't know how similar it is to what people are talking about everywhere else. Does this mean we should have more regulation? Like the new scandal in surfing now is they have a new technology, which is inflatable vests. Right? So this vest lies right on top of your wetsuit. And if you wipe out, you pull a cord and it turns into a flotation device that will bring you to the surface. And everyone's concerned this is going to increase more risk taking and more people are going to be surfing who don't belong there. So there's this big brouhaha about selling this vest. And should anyone just buy this vest? So there's two makers of this vest. One is being more liberal about who it sells it to. The other isn't. And people are very upset about the other. And I'm sort of like, in finance, you would never expect someone who sells a derivative to just not sell it to some people out of some sort of ethical reason.
Right.
Maybe you need a third party. Maybe a big wave surfing should be licensed the same way scuba diving is or something. Maybe it's too much to put on merchants who spend all this money developing these technology for you to then expect them not to make a profit off of it. So they hate that. They don't like the idea of having the government involved. No. But I think it's a worthwhile question.
And this is this thing, the Peltzman effect, right? The idea of that technological change can increase risk. Presumably it does in the finance world, as we've seen. With the
Peltzman effect was initially about driving. Like if you have seatbelt anti-lock brakes. But here's the thing. It's like, first of all, it's the fact that you might take more risk when you have more safety. I think the evidence suggests in all of these cases, on balance, we're still better off with the technology. Sure, people might drive faster, but road deaths, this is the public safety improvement you never hear about, are way down from where they were in the 70s. Anyway, people drive a lot more. And that's just because all these safety technology, anyway, we might drive more recklessly, have made us on balance so much safer. And I asked the surfers too, the same question we have about financial technology. Like you're complaining about leashes, you're complaining about jet skis, you're complaining about inflatable vests. Do you wish they would just go away? And we would go back to this heyday you talk about in the 50s when there was only 5 guys out there and they all knew how to swim well. And they were like, well, no, of course not. We wouldn't go back to that because the sport is so much bigger and reaches so many more people.
Right. Yeah.
And there's so much more upside to it. We wouldn't go back there for all the money in the world. And I think the same is true of derivatives and financial markets. We might, as Volcker says, we should get rid of everything that's not the ATM. But, we don't live in that world anymore. We're in a much bigger, more financially interconnected world. where people have more need for risk management. And I mean, given all the improvements in quality of life and people coming out of poverty, I don't think there's any real question that we would want to go back to a world where there were no financial derivatives.
Right. And it's like anything. There will always be people that push the envelope a little bit, probably no matter how much you regulate. Mm-hmm. There will always be someone like, Alex Honnold, who's going to free solo a mountain mm-hmm. without a harness. There will always be people trying to surf bigger waves, and it's kind of difficult to stop that minority of people. But also that's somehow there are innovations that come from some of that testing as well, mm-hmm. that then trickle down. I'm a cyclist. I'm a road cyclist, and I mm-hmm. wouldn't want to ride a bike that was 30 years old. Mm-hmm. I'd rather have something that's modern and faster, but also safer. Mm-hmm. It's the same in most industries. Yeah, for sure. And it's I think, but it is always a legitimate question, is if you're taking those risks and they pose harm to others, where, and it's like with cars, we've got speed limits, we've got mm-hmm. regulation. So I think it's always that question of what is the regulatory requirements versus personal responsibility? It's a complicated question. The one area that I was thinking about this as I was reading the book was around social media as well, because the social media, and also actually there's a wonderful podcast called The Happiness Lab. I don't know if you've heard of it, but the last episode actually discusses the ATM mm-hmm. and the fact that the ATM certainly reduces the amount of time that people have spent in lines and queues and mm-hmm. banks, but also that all of these types of things reduce face-to-face human interaction, as does mm-hmm. social media and all of these kinds of things. So there's that unintended consequence of all of that, and all the stuff that we're seeing about the mental health crisis around the world, etc., mm-hmm. that relates to social media. So some of these things are moving so quickly that you've got big wave surfing. Surfing is a thing that you can perhaps regulate mm-hmm. and put some sort of a box around, but some other areas it's quite hard to keep up with all of the changes and unintended consequences. You do, but you see as well where there's also this need to regulate all these technology firms. I'm not sure if the regulatory aims of what they're saying they're going to do are going to address the problems they're talking about. Mm-hmm. But there is, as I said, that regulatory push. I'm amazed by the risk people take on social media. Like, you think about the downside risk of like an off-color tweet that could just destroy your life. Yeah. And, everyone has off-color moments in their life. Yeah. And the idea that, this is one of the reasons I'm not very good on Twitter, is I'm way too thoughtful in everything I write because I'm paranoid that I could destroy my career by acting. But the upside of some people I know become incredibly successful because they have great Twitter personalities, but that comes from being a freedom I don't have on Twitter mm-hmm. of just every idea that pops into your head, getting it out there. People love that, but of course there's a huge downside risk to that too. Yeah, it's difficult. But the more that people do it, though, the more that I see that those types of things copied, and what works and what doesn't work becomes a little bit clearer. But again, you need some of those people that push the envelope a little bit. Yeah, or just if you're spontaneous, you never know how things are going to be received. And being good on Twitter means being spontaneous. That's true. And but if you're spontaneous, you might say something that inadvertently offends people, and then your life will be horrible. That's true. Absolutely, it's a challenging time out there on social media. But it's so much upside. I mean, what I love about social media, particularly as an economist, is econ Twitter, where you see these formerly obscure economists who you never would have heard of before becoming, really have interesting ideas, and they get so well known, and they should be. Normally, in any other world, if they were a professor at Harvard and publishing in a top journal, you'd have never heard of them. Right. But now there are these people having this fascinating conversation, having these amazing economic insights. So, I mean, the upside is incredible. But there is some downside too. Yeah, there is. I'd like to touch on a few of the other parts of your book, and I love the chapter on the paparazzi. I love a lot of the chapters, but the one about the paparazzi is really interesting, and the different types of risks. And again, probably was an interesting assignment to spend a little bit of time with some of the paparazzi. The market for celebrity photos is quite interesting. It was so fun. Yeah. Could you talk a little bit about that, the lesson that you're trying to make around the systematic risk that's out there, and how the world can kind of change markets and change things?
Yeah, so the paparazzi have a very complex risk problem. As you can imagine, their income is incredibly variable, and unpredictable, because, whether or not you see a celebrity like engaged in some affair, that could be a game-changing picture that will change your life. And whether or not you get that picture is pretty random. Mm-hmm. Or you might spend a full day waiting to get a picture of someone getting coffee and it doesn't even happen. So this is what we call idiosyncratic risk. Mm-hmm. So the risk that an individual stock would rise or fall. And the way you manage that in finance is you just diversify. You hold like a mutual fund. A mutual fund, you don't know hundreds of stocks or thousands. You don't notice what happens to one stock. So the paparazzi try to do this too. And what they do is they form alliances of other paparazzo, and they share tips, or they might share royalties, depending on whatever arrangement they have. And this would reduce their idiosyncratic risk. But the problem is, like, you always have an incentive to cheat on your alliance. So these alliances are always very unstable. So they're always falling apart, and they have to deal with this idiosyncratic risk, and they all hate each other. Like the paparazzo I spent time with has since left and moved back to the Dominican Republic, and I saw him the other day because he was visiting, and even he's still bitter about these alliances that fell apart.
Wow.
But the reason he actually left was actually more of a systematic risk, which is, systematic risk is the risk the entire market will fall. And that's what's happened to them, is that as they sell their pictures through intermediaries, these agencies that then sell them onto the magazines and the websites. And just because the market for glossy magazines changed, the magazines started demanding subscription models where they don't pay per photo, they just pay a flat amount and get to use all these pictures. And then the agencies all consolidated, so they said fine. And it left the paparazzo with no market power. So they just got squeezed. And so now a picture that maybe would have been $15,000 will now be like $5. Mm-hmm. So that's a much harder risk to manage, just like systematic market risk is much harder to manage. And it means a lot of people are leaving the industry because it's just, you can't earn a living spending a full day waiting for a $5 photo. And, it also just speaks to, I'm sort of fascinated now that I've spent time with the paparazzi. And that one thing people always say after reading that chapter that surprised them is they feel sympathy for this population, because they've certainly get to be vilified by celebrities as these stalkers who ruin their lives. But you start to appreciate when you spend time with them that the paparazzi are actually really part of this infrastructure that makes people famous and quite rich. Like in the beginning of their careers, they always are tipping them off as to where they are, because this is how they get famous and rich. Right. And these poor guys are like out there waiting for like hours for like a $5 photo, and they never get rich. Yet for some reason they're vilified as, these vultures. But it's actually a lot more complicated than that.
Yeah, it sounds like it. As you were talking, I was just thinking of, it's just, don't hate the player, hate the game kind of a thing, because it's that whole celebrity economy that they're a part of. So,
yeah, they're a cog in this machine and probably making less money than anyone else.
Absolutely, yeah. The Dominican paparazzo that you worked with, I can empathize with him a little bit, because he sounds like an immigrant and was worked hard to build up this living, and nothing inherently wrong with that.
No, and he's so proud of this identity as a celebrity photographer. Right. We actually have the same birthday. Okay. And he was showing me a picture of his birthday cake that was in the shape of a camera. And he had an alliance that went for 10 years, which is one of the longest alliances ever. So, and he is so proud that he was the head of this alliance. He actually, he talks about, I was so lucky I ran into him, because it was hard to find someone to work with, because they're not a very open-minded, open group. But the professionalism and pride that he took into his industry was really something.
How did you run into him, or was it just a little bit of chance, or how did that come about that you wanted to explore this market?
Well, someone mentioned to me, I was talking to someone, I'm looking for stories. They're like, oh, my friend's husband's a paparazzo, and he says there's all this interesting risk stuff going on. And I'm like, well, I've always wondered how this all works. Right. So I asked this husband to talk to me, and he said no. But then I was intrigued. So I'm like, I really need to figure out how this all works. And I'm super lucky that I don't know if she still lives here, but I used to live a couple blocks away from Gigi Hadid. And she's a very frequent target of the paparazzi, or she tips them off. So they're always outside her apartment. So every time they're there, I'll just run over and be like, hey, I'm a journalist. I'm trying to do a story about the paparazzi. Would anyone talk to me? And they'd always say no and tell me to go away. And then they're like, we like our privacy. I'm like, don't you want to tell your story? They're like, no, we like a private life.
Right.
So eventually, though, I met Santiago, who I think was different just because he has so much pride in what he does. And he agreed to work with me. And so I guess it was a bit by chance, but I'm quite lucky that I live so close to where a lot of celebrities live.
Right. Well, he's doing an honest day's work, is getting paid for something, providing a service that's in demand, and he's getting paid for it. And you contrast that. I love stories about fraud, and they just fascinate me. So your one about Crazy Eddies is pretty interesting, and how you relate it to probabilities. Could we talk about that a little bit? For when I grew up, there were all these adverts for there's some discount electronics chain, but I guess Crazy Eddies was the New York version of that.
Yeah, so it's amazing because it was so many years ago, but everyone in the New York tri-state area remembers these ads. So it was this family in Brooklyn, and they opened an electronics store in the 70s that they sold discount electronics. But from day one, they always had this idea that they would make their real money skimming profits. So it was actually tax evasion. So they'd underreport their earnings and keep the rest. And they had a good business going with that. They made like several $1 million doing this in the 70s. But then there was this young stock boy named Sam. They're all named either Sam or Eddie, which is very confusing. Sam was telling me that when they actually had the SEC had their case against them, they had to make a very elaborate family tree, because he says that everyone in this family gets that one of those two names.
Okay.
So Sam was working as a stock boy, and they noticed that he was always reading the Wall Street Journal. He saw that nerdy, like Alice P. Keaton kind of kid. So they decided to send him to college so they could figure out how to make even more money. So they sent him to college to learn accounting fraud. So when he was set to graduate, he sits them down. He's like, this is an illegal business built on let's make money from defrauding the government. And then they had this idea, like, well, let's take this public. Like sell shares on the stock market, an illegal business. And they worked out this whole plan to take their company public. And it started with them starting to increasingly report a larger share of their earnings. So it looked like they were getting more and more profitable to drive up the price when there was the IPO. And that worked. And they got super famous. I mean, they had these ads that were just everywhere, which seems insane. Like, to me, I hear this. Sam's telling me this story, and I'm like, this is crazy. First of all, you were running an illegal business and you took it public. That's just, on its face, is so crazy. And then, not only that, you have the most memorable ads of the decade. People still talk about these ads. It was on Saturday Night Live. It was in that movie Splash. Again, if you're going to run a massive fraud, you should keep a lower profile. Like he says, they were hiding in plain sight, but it's like, eventually that's going to come crashing down. And of course it did, because eventually the company was bought out in a hostile takeover because they didn't own the company anymore because it was public. And, the new owners came in and noticed that all this inventory didn't exist. And they, Eddie went to prison. Sam did not, because he turned on his family. And it's sort of just like, I'm just sort of still baffled that anyone would just think this was a good thing to do. And it just shows that sometimes we just don't make good risk decisions. It was interesting. I spoke to some other criminals in a large variety of crimes, and they all said the same thing. I never thought I'd get caught. And they always say, in the beginning, I was worried I might get caught. But then, I got away with it. And then I got away with it again. And then I figured, well, I even spoke to these guys who, grew up in areas where everyone went to prison. I'm like, well, when you started doing crime, did you just feel like it was inevitable? They're like, no. I looked at everyone who else went to prison, but I thought I was smarter. And no, statistically, you got to know you're going to get caught, especially as you get bolder and bolder. And it's just because sometimes we're just not very good at inferring probabilities. And there's a lot of evidence for this. I mean, I think this is an example of not only overconfidence and underestimating risk, but also just inferring serial correlation when there is none. Like you think because you get away with tax fraud, you can get away with securities fraud. Like there's really no correlation there. But I mean, maybe there's some, but not a lot. So I think it just is an example of how people underestimate risk.
It's also, it's similar to this concept of resulting that I spoke to Annie Duke, who's a former World Series of Poker champion, that you make a decision and it either goes your way or it doesn't, but you infer a level of skill to what might be down to luck. And you might have, like in poker, you might have played the right hand, but you didn't win. You didn't win the hand, but you played the right hand, or you played the wrong hand and won out of sheer luck, and you attribute, luck to something that you attribute skill to something that's down to luck. And I suppose just talking to other people who've somehow good people that have done bad things, as you sort of, as you say, the first time you do it, it feels not right, but then you get away with it a few times, and then it feels like, well, this is what's going to happen every time.
Yeah, I also interviewed a guy who did counterfeit fraud. He ran a counterfeit subsidiary of a gang, drug gang. And he was telling me the story of how he had all these elaborate risk controls, and they always say they do. I found every criminal is very excited to tell you about whatever risk strategy they had. And it never sounds very good to me, but they always think it was foolproof.
Right, okay.
And so he would counterfeit bills and then spend them and take the change. And he had this group of buyers who would do this for him. And so he gets caught once, and they take him in, and they really just didn't have enough evidence, or he seemed kind of small time, so they just sort of let him go. And in his head, he talked himself out of it. Like, he still to this day thinks he talked his way out of it. He's like, I was smarter than them. I convinced them that it was fine. He had all these elaborate little ticks he did to make them think that he was anemic or something. And so in his head, this is a good example of resulting, he thought that he was smarter than the police. But then he gets caught again, and now they have a record that he'd been picked up before. Right. But in his head, the fact he gotten caught once emboldened him to take bigger risks. But really, if he was more aware, he would have realized that he was actually of higher risk now.
Right. And we all do resulting or similar type of behavior in small ways or big ways sometimes. It's not just something that criminals do. But actually, you organize some of your chapters under these, all of your chapters under these sort of 5 rules. And I just wanted to go back and maybe just make sure my listeners understand those rules. So the first one I think we talked about, which is, no risk, no reward. Second one was around irrationality and knowing that we're irrational. Could we talk about, which ones haven't we just touched on?
Well, we still haven't talked about diversification.
Okay.
Which is effectively like taking, you have to take some risk to get what you want, but there's no reason to take more risk than necessary. Right. So in finance, if you have 2 portfolios, both have the same return, but one's riskier than the other, you would never take the riskier portfolio. It's just why. It's inefficient. It's like overpaying for something. Like risk is the cost, reward is the benefit, and why would you pay more? So in finance, diversification is how you get efficiency, which is, you're going to have a similar return investing in 2 stocks or expected return as you would 2,000. But investing in 2,000 stocks is obviously a lot less risky.
Right.
And then we talked about risk management, which is the next one, is once you've figured out your efficiency, you want to manage your risk. So try to keep as much upside as you can while getting rid of downside.
Yeah.
And then the last one is uncertainty, because there's always some, risk is everything you can imagine happening. But there's always something we call off-distribution risk, like some risk that you just never saw coming. And then the question is how do you manage that?
Right. And this is the chapter about the military planner.
Yes, H.R. McMaster.
Yeah.
Yeah, who but until he joined the Trump administration was actually known as a great risk scholar. And he is particularly focused on over-planning and feeling like because you've planned everything that you take you take risks and you don't know how to handle it when something happens you don't expect.
Right.
Which is fascinating because of all the chapters, that was the one I always knew what the story would be. Usually I had to kind of discover the story and see what fit. But with that, I always knew it would be about war because you think you go into battle, things must always happen that you don't expect.
Sure. Who was it that, Eisenhower who said that plans are useless, but planning is indispensable?
Yeah, and I think that's it. I mean, you get a lot of criticisms for financial models because, risks happen you don't anticipate. But it's like that still means you got a plan. I mean, if something works 90% of the time, then that's still better than not. You still should use it. 90%'s a lot, or even 10%'s a lot. But the thing is, you have to understand when to abandon your plan or not be so invested in your plan that if something happens you don't expect, that you're stuck with it. And I think that's what often, as HR, after talking to HR and then reading a lot of military history, you can just see all great empires rising and falling based on this question of how much do we plan and how much do we leave to chance? How much do we empower our soldiers to make decisions on the fly versus having every battle pre-choreographed? And it's a tough balance. You need to have some of both.
Right. Yeah. And I suppose that also affects the types of soldiers that you have and how you train them. You don't want automatons. I always find that interesting in the military, that kind of think of military people as you obey orders no matter what. But in the fog of war, you need some flexibility in thinking and doing.
Yeah. And unfortunately, that's a lot harder to plan for. It's more expensive. If you want soldiers who can make good decisions in the middle of the fog of war, you've got to invest a lot of money in training them. And I think that's one of the reasons why militaries always fall for this sort of seductive idea that they can pre-plan everything, because it's a much cheaper way to fight a war.
Right. Yeah. Yeah. It's all of this stuff it comes together very nicely in this book, which, as I said, I really enjoyed. Was there anything in the course of doing the book that you either left out or you would have loved to have included, or something an expectation that you had that as you did work on the book and did your research, it turned out a little bit differently?
No. I mean, I know that sounds strange, but I think when I wrote the book, I spent 3 years thinking about what it would be. Mm-hmm. So I had a very tight outline. I mean, what was left to chance was the stories. Like, I just didn't know what stories would fit, and they all did. Because what was surprisingly easy was finding stories that fit. It's just everyone takes risk, and I find something that unites anyone who's good at their job is that they're good risk takers. We never think about it, but if you find someone who's, you kind of always find that most interesting, successful person in their industry that you can, and anyone who is probably has a really interesting risk strategy. I
agree. I've had that same experience working with people that in my professional life, whether they're CEOs or decision makers or an entrepreneur, pretty switched on supplier that may not have that language of risk management, but maybe it's not intuitive. Actually, it's probably quite deliberate, but they do have it, and perhaps it's born out of experience. But they may not have the language. They may not talk about diversification and hedging and things like this. But that's exactly what they do. Were there lessons from the book that you apply in your own? Has the book or has your work changed the way in which you make your own decisions?
Oh, yeah, absolutely. I mean, I guess, the book reflects, a lot of training and thought I've had around risk for years. So I don't know if the book changed it or I've been thinking about it for a long time. But I definitely think like this. I think I definitely think like a risk economist. Mm-hmm. I mean, not always. I mean, sometimes I definitely take weird chances. Like, this is sort of a trivial example. But recently, and I think we all fall for these sorts of things, a local spa came out with you can get a discount package if you pre-commit to 5 treatments, and we'll give you this huge discount if you do. So, you're psyched, you go forward with this. And then 2 months later, they go out of business and they're not honoring their packages. And I'm like, oh, the discount was really me taking on default risk. I never realized it. It seems so obvious. I was complaining to my mother about this, and she's like, well, yeah, you're a risk economist. What do you expect? When you buy a package in bulk, if for any business or personal training or whatever, you're taking on default risk. Yes. And it's just like bonds that offer a higher return have a higher rate of default.
Yes.
So really, I mean, the good thing is I had some bond insurance in the name of Amex, so it all worked out. But it is something, you think about. I'm like, how did I miss this? This should be my thing.
Well, yeah, you can say, how did I miss this? But I'm just thinking about, the WeWork thing right now. And a whole lot of investors seem to have missed some pretty basic fundamental risk factors in looking at that business model. It's effectively the same thing. It's a company that's taking out these long-term leases and then selling them on a short-term basis. So, yep. So what do we expect?
Yeah, I think we're going to look back on this era of venture capital and be like, why did so many companies invest in companies that no prayer of ever earning a profit? It's going to be an interesting reflection someday.
Yeah, and I wonder why that is.
Well, my personal theory is that the LPs, their risk incentives are distorted. Okay. Right? Because if you're a public pension fund, you have a very different.
Okay.
Your risk profile is very different. Like effectively, you want, like, private equity is a really handy asset class if you're a pension fund or even an endowment, because you're judged year to year on your performance, and no one's really thinking long term how you perform. But a VC will just say, yeah, we earned 16% on that vintage this year. And people will be like, great. And so you get this higher return, but you don't have to actually realize these risks until much later. So they're all kind of in bed together, which I think is just, like, it's always interesting. When you see a broken risk market, you always can see, like, what's went wrong here? Like, how are the incentives not lined up? And sometimes it's lack of transparency, and otherwise it's just distorted incentives.
So much of the world comes down to incentives, doesn't it? You can explain so much by looking at different incentives.
Absolutely.
And when you have a lack of transparency, it also becomes the trick, the difficulty. What are the incentives of those in the market? Yeah.
Absolutely.
What are you working on now? What projects are of interest or? Well,
I have the will to write a second book, but no ideas. But I guess it starts with a will. Yep. But mostly now, I'm just doing a lot of speaking and sort of thinking about my next book idea.
Do you have any hypotheses or anything that you're trying to explore, or any just general areas of interest that, would it be a similar book to the one that you've written, or?
Well, I'd like to do something new, but I keep getting stuck with the fact that risk is what interests me as an economist. It's what my training is. So I don't want to go too far. I want to do something on risk, but I also really love storytelling. So that would be the last book, but I just have to find a new original way to do it.
Right. Well, you mentioned you're looking for risk in certain spaces, and I think there's a lot to be said for exploring the world of extremes. I don't know if that's something of interest, whether that's ultra endurance athletes or people that are trying to push the edge on technology or these kinds of things. Yeah.
That's a good idea. As I said, in the extreme, in the tales you always see how
tales, yeah. I'd be very interested in reading a book like that. Taking some of this, yeah.
That would also be really fun for me to research.
Yeah. I think there's a lot of places where you could go to get some interesting stories as well. We've covered a fair bit here. Was there anything that you wanted to mention that we didn't get a chance to discuss?
No, I think I'm good.
Cool.
This has been really fun.
Yeah, this has been great. I thoroughly enjoy this. I know my listeners are going to get a lot out of it. For my listeners, where could they find you and learn a little bit more about you? And I know you have a newsletter and all of that good stuff.
Yeah, I have my newsletter. I have a website where you can find a lot of my writing, AllisonSchrager.com, and obviously I'm on all the social media stuff, mostly Twitter, with Allison Schrager.
Fantastic. I'll put all of those links in the show notes.
Okay, great. Thank you.
Allison, this was great. This was a lot of fun. I really appreciate this, so thank you very much, and wish you all the best.
Thanks for having me. I love the idea there's a podcast devoted to risk. I'm so glad you had me on.
Thank you.
Thank you.
Thanks so much.
All right, I hope you all enjoyed that and found that as interesting and as insightful as I did. Give Allison a follow and definitely check out her book, An Economist Walks Into a Brothel. Links, as usual, are in the show notes to everything that we discussed. And if you enjoy all things risk, as usual, I ask you to do us a bit of a favor and give us a positive rating and review, particularly on iTunes. But wherever you get your podcasts, it certainly helps us out a lot, and it's quick and easy to do and also free. So highly appreciated if you do that, and a big thank you to all of you who have done that already. We will be back next week with our next episode. Until then, and as always, don't forget, risk is life.